Hey guys, today's interview is with Kevin Bennett of MotoRefi, coming to us from Washington, D.C. Kevin talks about how fundraising is really more about discovery than persuasion, and how you can use fundraising to, set up a series of meetings and talk to some of the smartest people around and really use the fundraising process as a brainstorming session. So lots of interesting nuggets here. If you like this content, hit that subscribe button, leave us a comment in the comment section below, and then email us info@foundersuite.com, and I will send you a list of the 500 most active corporate VCs. So if you're thinking about corporate VC or strategic capital, this is a great resource for you. So hit the subscribe button, leave a comment, email us at info@foundersuite.com, and we will send that off to you. Until then, enjoy the talk with Kevin.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today I have Kevin Bennett of MotoRefi coming to us from Washington, D.C. How's it going?
It's going great, Nathan. Thanks for having me.
Yes. How's the weather there in Washington, D.C.? Things are probably calming down now after the craziness of January, hopefully.
They are. I think that's what we all hope. We had a little bit of snow, which is unusual for us, and now the skies have cleared up. It's a bit warmer, but can't complain.
Very good. Are you a native of the area, or are you a transplant?
I am. I actually grew up around here and spent most of my life here, and most of my experience in the startup world is here as well.
What's the startup scene like in Washington, D.C.? I'm not too familiar with the area as a startup hub, right? You think government, right? You think Washington.
Yeah, absolutely. I think it is. I think about startup ecosystems as, in one framework, what are nascent scenes, what are self-sustaining scenes, and then obviously the massive thriving scenes. I think we're in a self-sustaining ecosystem here in the Washington, D.C. area. Legacy from AOL and all of that, tech from decades ago. We've had success stories through, the rise of Living Social, O-Power, other kind of successful startups that have, gone public, been acquired, those types of things. And there are family trees of talent that have worked in different locations. So it is definitely a place you can make your career in startups. I have certainly done that here, and I'm happy to do it. But I would say smaller pond, but also easy to know where the talent is, and maybe a bit less competitive than a Bay Area.
Yeah, interesting. All right, let's get right into it. So what is MotoRefi? What do you guys do?
MotoRefi is a software platform that makes it easy to save money and improve your financial security. And we do that by helping consumers as it relates to their car and their auto financing. And so we, first and foremost, help consumers refinance their car online and save money. The idea and concept of refinancing your car is actually not a household event or a household concept for most folks. Only 47% of people are even aware they can refinance their car. Only 1 to 3% of auto loans are refinanced a year. But the asset class is just over $1.2 trillion, the same size as student lending and student loan market. And most consumers can actually save a good bit of money refinancing their car. And so while folks think about refinance, they think mortgage. Auto actually is a place that you can save a bunch of money, and we save our customers an average of $100 a month on their car payments, and that's obviously $1,200 a year. That's groceries, gas, stuff for the kids, paying off bills. So we help kind of middle and working class folks do that, and we also help them with their insurance-related products around their car as well, and help them optimize the kind of pricing and around those products, and save our customers, sometimes the upward of $1,000, $2,000 by getting them in better, kind of more affordable products when it comes to their auto-related insurance products as well.
So is it all refinancing, or is it also financing at time of purchase? And why or why not?
So it is refinancing. I think one of the interesting aspects of financial services in auto is that it's generally defined by that dealership experience. When the consumer goes to the dealer, they'll spend weeks or months, shopping their car, make, model, features, and then they'll end up at the very end of that transaction, the last 15 minutes or so, they get all their paperwork around their financing and insurance products. Most consumers just can't wait to drive off the lot in their new vehicle. So they kind of check, sign, and may or may not even know what their interest rate was, or what what insurance products they had, or how much they were paying. And so there's just an opportunity to help a whole whole bunch of consumers, 80% actually, of folks are driving off the lot kind of in products that are more expensive than they could be and paying more than they could or should be. And so we help them that way. It's funny. I don't know if you got a chance to see, the football game last night and the commercials around it, but Vroom actually had a commercial and talked a little bit about that. And they're offering an alternative to dealers in the way they do it, as are Carvana and others. And so I think you're starting to see innovation in the space, starting to see more consumer-friendly applications, whether it be to purchase a car or finance or refinance a car. But for all the people who aren't going through a Vroom or Carvana or going through the traditional dealer method, we can save a lot of them a whole bunch of money refinancing their cars, and are pleased and privileged to be able to do so. What
was your background? How'd you come up with this idea? Were you in the car lending business, or were you a disgruntled customer who felt like he was paying too much, or some other variation here?
It's a great question. I mean, I had gone through the process, and I remember going through, in particular, with a lease, and I was going to pay cash for the down payment. And they said, well, if you do that, the car's more expensive. And so whenever someone tells you it's more expensive if you pay cash, you kind of wonder to yourself why that might be, and whether incentives are aligned. And so that had stood in the back of my mind. And I was heading off to graduate school, and so didn't think too much of it. Like most consumers, you just drive off the lot and put it behind you. The interesting thing for this business is it's a venture build out of QED Investors based in Alexandria. And QED is a boutique fintech venture fund, and it's founded by Nigel Morris and Frank Rotman. And Nigel Morris was the co-founder of Capital One, COO there for about a decade, left, and then founded QED. And right around 2008, they led the Series A of Credit Karma and a whole bunch of other fintechs. And so they invest heavily in the fintech space and are pretty deep in their expertise there, and a great fund. And mostly ex-operators, and they started thinking where they saw an opportunity in the market. Maybe there wasn't a startup or anyone that was kind of taking the approach they'd take. Hey, maybe we'll spin something up ourselves. And so when they were just getting started with this, and had hired 10 people, they were working out of QED's basement. It was kind of the equivalent of do it in the garage, but in your investor's basement, and we're getting started. They were looking for a CEO to partner with them, and I was just selling my last business, and we had gotten to know each other previously, and I was really excited about the consumer opportunity. QED was excited about that, really deep in the capital markets side. My background is verticalized software, mostly B2B2C startups. And so just a tremendous opportunity to build a great consumer-friendly, consumer-focused brand that could have a real impact on people's lives, be mission-driven. And it's been a lot of fun. So it's been just under 3 years so far.
So they recruited you in to kind of to lead it after you. What was the previous business that you sold?
Homes End. It was real estate transaction, residential real estate, but similar, kind of adjacent to the mortgage space. So through a similar startup there. But yep, that's right. I mean, we had known each other, and there was some matchmaking where someone said, "Hey, maybe you two should talk about this fit that y'all are thinking about," and it ended up being serendipitous, and we it's been a really exciting 3-ish years so far, and it's worked out pretty well so far.
So when a startup is spun out of a venture fund like that, how does that work? Does QED automatically have a pretty big chunk of it, and they're also putting in some money to seed it, or how's that work? What's the structure like?
Yep, that's right. I mean, I can't speak to all structures, and it's certainly not like an accelerator, like a Y Combinator. It's kind of a different model, but in this case, that's right. They would put the initial resources in, and work very closely with the team. Part of the opportunity that has been really wonderful is QED is incredibly deep in financial services and fintech, and they've done incredibly well. They know the space very well, and so I would say often the case that there's a euphemism of kind of investors being partners in the business. But in this case, they are very much our co-founders and partners in the business, and really incredible to be able to work from early days with such great investors and operators who know the space so well. So it was a huge asset for us getting started. It was kind of our unfair advantage. People talk about unfair advantage a lot, and that was ours. And it really worked to our advantage. It was incredibly helpful getting us launched and on our way in the market.
Are the two gentlemen still involved, or do they kind of hatch the idea, recruit a person like you, and then are they fairly disconnected from it now, or are they still on the board or something?
Yep. No, I still speak a good bit with Matt Risley, a partner there, and Nigel Morris and Frank Rotman there from time to time. They're always there and willing to be helpful and email back and forth. And Matt Risley is on our board and an incredible partner in the business. So, but in close touch with them, and they continue to be great advocates and partners in the business.
Okay, cool. Great. Let's talk about raising money. So how much has the company raised? And I guess, can you share what it took to launch it and the QED back its initial days, and then maybe carry on that tail or chronology into newer rounds?
Yeah, this is a great question. So in the early days, just the getting up and running, the what would often be bootstrapped or really kind of founders using their credit cards, doing whatever they can to get something going. We were fortunate that we had QED as an investor, and they were investing in the company, and that was part of that model with venture build. And the idea was always that we would move out of mom and dad's basement, as it were, and actually get our own apartment and all of that, the equivalent. And we did. And we, as we commercialized and got up to speed and launched in our first states, we moved out into a sublet and then raised our own kind of proper seed round with outside investors. And QED participated in that, but added some great investors. That round was led by Accomplice out of Austin and Ryan Moore, who co-founded that fund. And Ryan has been on the board ever since and a really incredible partner in the business. And then after that seed round, we kind of started really getting to work scaling, going national, starting to continue to grow and expand. And then the late 2019, early 2020, we raised a Series A that we closed in Q1 of 2020 last year. So about a year ago. And that was just under $10 million. And that was a traditional process, a traditional Series A. And that was co-led by Link Ventures, a venture fund out of Cambridge, Massachusetts. So down the street from Accomplice, as it were. Accomplice co-led that as well. So Accomplice and Link both led that round. And I think at that point, rewind about a year, 18, 24 months of runway, business is growing, expanding, and COVID hits. No one knows quite to make of it. We had a little bit of a hunch that, we help consumers save money. And as they're looking to save money, we can help them, shore up their finances at a time where that can be more, top of mind. Yeah. And I think we saw that in terms of consumer demand. Candidly, there were questions on, well, what are your lenders going to do? And what is the financial services industry going to do? And it really hung in there. And our lenders are phenomenal partners and wanted to keep growing with us, which we were humbled by. And so new lenders kept signing up. We expanded with our existing lenders. In the latest round announcement, we mentioned that we grew monthly revenue 6x last year. We ended up growing the team 3x. We doubled the number of lenders on the platform. Which is pretty wild when you think about that all happened in the pandemic when we were fully remote. And so it's like the majority of folks had never met each other in person, but we were able to really continue to build, execute on the mission and scale. And then, I would say that while that Series A in Q1 was very intentional and we had a fundraising deck and we went out and we did it kind of the traditional process, as we really started growing and accelerating in the second half of last year, of 2020, we started to get more inbound interest from investors who were interested in our growth and kind of the timing and how we're continuing to expand the business. Mm-hmm. And we got a lot of interest. And that was a little different because we weren't raising, we didn't have a deck. We weren't, doing a quote unquote roadshow, as it were. It was more of opportunistic and organic conversations, which was a completely different style of fundraise. And it worked out well. We were fortunate. We had a number of what's, I guess, called preemptive term sheets. We weren't raising a Series B yet, but folks who were offering to help us fuel up the tank or top it off a little bit for 2021. And while some partners, weren't the right partners, we did get a great partner in Moderne Ventures who did lead that round, another $10 million that we closed in Q4. And that was a great experience with a great partner. And Moderne is a great consumer tech-focused fund. They do a lot in the real estate space. Obviously, refinance in real estate is very well known, and there were a lot of interesting synergies and opportunities to work with them. And it's been great. Liza Benson joined the board. She's been fantastic. And it was, as you would probably gather, a lot less stressful in that, my goal from now on is to have fundraising be a two-way option, not a one-way option. And so it's a lot easier to raise when you don't need the capital, as opposed to I've now run out of money and I need to go find more money.
Yeah, for sure. For sure. The Q1 raise, did you get that done right before COVID hit, or did you kind of close it right as COVID was happening? Q1 is, January, February, March. So it's like, it kind of probably depends on when you closed it in Q1, but what's your answer? Yeah,
it was about a month before anyone had ever started talking about COVID or was aware of that. And so, sometimes you'll just take luck when you can get it. And we certainly had it at that point. Yeah.
Talk about that one. So that was more the outbound run a process approach. Did QED they didn't lead it, but did they sort of lead the charge there and getting you guys plugged in, or is it something you did? Like, talk about putting the round together.
Yeah, it was something I led as the CEO of the business, and it was great. Some people really dislike fundraising. I actually enjoy it. I don't want to fall in love with it too much because it's not obviously leading a business, but my perspective on it was and is it's a great way to talk to some really smart people who will have great feedback, and they're just brainstorming sessions where you show up and you talk about your business and you ask them, what do you think? Do you have a thesis on the space? What do you think about fintech? What do you think about auto? What do you think about what's going to happen in personal finance and trends? And you have a great brainstorming conversation, and look, maybe capital comes of it, maybe not. But I think we're in a situation today for sure where capital over time in a business's life cycle becomes more and more of a commodity. And so really it's about picking the right partner. And in these conversations, if you can kind of approach it in a, not the high pressure sales way, but in a more collaborative and casual approach, still being thoughtful, still being respectful, still being well prepared, then I think it makes for an easier and more productive process.
Did you, it sounds like in the most recent one, you didn't there wasn't the pressure to go raise, but in that Q1, I guess the beginning of the Series A, is this most recent one a Series B or just another Series A part 2?
We call it an A1, so a Series A part 2 in the kind of scope, and some of that's more about the legal documentation and the different things we did. But yeah, and the size of the round 2 and signaling. So
in the first tranche of the Series A, whatever we're calling that, I mean, how were you guys doing? Like, did you I like that approach of not feeling the pressure, treating it like brainstorming and casual conversations, and check comes of it. But did you guys have pretty long runway to enjoy that luxury of treating it casually, right? That's a hard part with a lot of startups, is they need the money in the next 3 months or they're out of business. So it's how do you treat these as a casual, relaxed process with that pressure? Maybe you didn't have the pressure. I don't know. You tell me.
It's a great question. I think, to your point, obviously it's easier to approach it that way when it's not an existential event, right? When you'll be fine either way, and you're going to continue building your business, and maybe there's an opportunistic moment to, as they say, put fuel, more fuel on the fire, expand the business, and really continue to grow. I would say in the earlier one, you can still do it. It's harder, but I think what worked for me and everyone. The other thing I will just caveat this is, everyone needs to be authentic to themselves in this process. And as whether you're a founder or a CEO or whatever your role is, and that's with your team, but it's also when you're raising capital. I don't think sometimes you get the image that there's one specific type of personality or a way you're supposed to do that. And I think it's really about playing to your own strengths and knowing your own strengths and being authentic to yourself, being open and collaborative around this. And I think the thing that a lot of folks don't realize, and from my perspective, venture capitalists are going to see thousands of pitches and decks like every year. They develop this sense of who's being authentic, who's not, where does it feel like something being hidden, and so I think that if you can just be yourself one, I think it's easier to try rather than putting on a different persona or something where it just is less natural.
Mm-hmm.
I think it just helps you. And the other piece is really internalizing and understanding the world from their perspective and their side of the table. What are they looking for? What are they afraid of? What needs to make sense for them to believe, what they believe and dedicate an amount of capital to your business? And I think that's really helpful as well, because if you truly can see both sides of the table, then you can be more collaborative because you feel like you understand the game from both perspectives. You understand the process. You understand kind of what that looks like. And I do think even if you're in a situation where you really do need to raise the money, right? You really do need to capitalize the business. It can be an easier conversation because you've done your homework and you're more familiar with what life is like from their perspective and what they're looking for.
You take that in a little more into more detail. Maybe if there are any specifics you could use, or even examples from your fundraising roadshow that you sort of adopted that approach. How did you put that advice to work on that roadshow? Like getting to know what they're afraid of and and their side of the world. Yeah.
Absolutely. I think it'll depend on stage, but a couple things that can be helpful. One is understanding, does the investor have a thesis about your space?
Mm-hmm.
Do they have a perspective that they're walking into the room with? Do they think, hey, we actually have, and how much work have they done? Or is this kind of a flyer? They don't know anything about your space and you really need to educate them on your industry?
Mm-hmm.
Or have they done a ton of diligence and research on your industry? They're interested in talking to you and they have a perspective on what they think will work or not work in this space.
Mm-hmm.
Just understanding what they're bringing to that conversation as opposed to coming in blind. And I think if you approach it the right way, they're happy to tell you. They don't want to play hide the ball. They want to say, yeah, actually, we really like this space. We think over time, there's going to be this trend toward X, Y, or Z.
Mm.
And then that helps you have more of a conversation of what does the future look like? What's your role in that future, right? But really understanding, do they have a thesis? What is that thesis? How strong is it or developed is it? It is really worthwhile. Otherwise, you really are blind in a conversation, unnecessarily so.
Isn't it tempting then to fit your pitch to that thesis though? And is that a healthy thing to do? Yeah.
I think it's certainly, you can see why people do that for sure. I think ultimately, and this is where the authenticity comes in, that will be, even if you could convince them of something in the short term in that meeting that maybe, that you share that perspective when you really don't, that will usually come through in the process, either because you haven't built your business that way or you truly believe the future is something else.
Mm.
So I think it is tempting to try and figure out what does this person want to hear and let me tell them that. And I think on the substance, that's wrong. In the process, it's right though.
Mm-hmm.
How understanding the investor and their thesis on the market and then sharing your perspective on that and kind of where your business is on that journey can be really helpful. And do they have quantitative questions? Do they have qualitative questions? Where are they excited? Where are they concerned? And so I think it's funny. I think I've said this both about raising money and actually about interviewing folks for the team, which is the process is much more about discovery than persuasion.
Mm-hmm. Sure.
An investor to invest in your company if they don't believe in it.
Yeah.
But if they believe in the space, as we were talking earlier, and they have a thesis or they believe in your approach to the space, then actually it could be a really good match. You may discover a good match and then you're there. But that's true of stage too. So I think of it in terms of if you're raising a Series A and you go have a conversation, maybe you get a great introduction to an investor that really leads Series B and Series C rounds, but you're trying to convince them to invest in your Series A, you're at a huge disadvantage. You're not going to have the milestones and metrics they want to see. You're not going to have any of that, right? So it's about matching and really understand who's the right type of investor for me based on my stage in my industry. And am I talking not only to the right fund, but the right partner in that fund?
Mm-hmm.
All critically important.
How much of that work did you do before meeting with them versus just taking meetings and kind of asking those questions in the meeting? You know what I mean? Research versus questions.
I think it's both. I think you want to do your basic research before because not only are they busy, but you're busy. You're busy trying to run a business, trying to raise money at the same time, and you don't want to spend a whole bunch of time with investors if you think it's not likely that they're the right, match or partner for you. And so if you can discover, it's like a lean startup methodology, test your assumptions. And how can you test your assumption about investor? Well, what are their last 10 investments? What is the stage been? What's the check size? What spaces are they in? Do you have any connectivity with those investors? Can you do any diligence about them even before you meet them? Right? Do you know? Sometimes the answer is yes, and sometimes the answer is no. But doing your homework sometimes can be as easy as sending someone a LinkedIn message and say, "I see you're connected with them. Like, did you have an interaction with them, and was it positive?"
Yeah.
And that is really helpful because, like any industry, there are many great people and there are some less great people. And so, if you can save yourself the headache and avoid the folks that you probably don't want to be spending time with, then that's all the better.
Would you do that very much? Like before the meetings, would you kind of do the pre-diligence? I like the concept. I'm just curious if you did it.
Well,
right.
In some sense, you're almost forced to sometimes because a lot of the conversations with investors can be like blind dates. There needs to be a trusted party in the middle introducing you.
Sure.
So that could be another investor. It could be another company they've invested in. It could be, just a person in common, like personally. And that's not always possible. But I always, when it was possible, would try to get an introduction through someone that knew both of us. Because one, it was positive signal.
Yep.
They're more likely to take that conversation and take it seriously. And two, you're doing some vetting through the process, that introduction as well.
Yeah. Good. Excellent. You mentioned, kind of this idea of flexibility of capital and how that's changed. Did you raise money for your first startup or your previous startup, or was that bootstrap?
Did raise a little bit. Yep. And it was it was a mix of angel, venture, family office. I think what you've seen is not only the size of rounds change, but just more flexibility in the way you finance your business over time. And I think this is really, certainly over the last 5 years, maybe a little bit longer, but I'll give you a couple examples. One is today you'll see seed rounds that are $1 million, $500,000. You'll see $10 million seed rounds. You'll see Series A that are 5 million, 10 million, 20 million. You'll see, so the letter sequencing may work, but the sizes of the different letters may be all over the map. And
Right.
So it reflects, I think, optionality and a more robustness of the funding and startup financing system today than there ever has been. There are more funds. There are more funds who are willing to work in different ways. And the system used to be very rigid, where you wanted to raise money for this round, called a Series A, and that Series A was going to be in this very tight range, and that's the check size. That's what you got. Whether you needed it or not didn't matter. Series B, same thing. And now you have much more flexibility. You also have venture debt and Silicon Valley Bank and all the other great folks out there. And so there are lots of opportunities, and there's more optionality around how you finance your business, how you partner with different investors. And we've certainly seen that path work really well for us, where everything from venture build with QED to the A1 with Modern has been incredibly helpful. And our thesis has been, there's a balance, which is every fundraising round, there's this hype cycle around it, and there are announcements, and they're in the papers, and it's flashy, and it's validation, but you're also selling a piece of your company. Mm-hmm. And so I think we're at the stage where you can raise the capital you need, but not overly dilute yourself or your existing investors or your teammates. Like, that's also great and something to keep track of. So I think it's a great time to finance and build a company from that perspective because of the optionality that exists in the market today.
Good. We'll let you get back to business, but any ways you'll sort of take that optionality, flexibility into future rounds? Are you thinking venture debt? Are you thinking corporate VC? I don't know. How are you thinking about future fundraising, and does that optionality play into that strategy at all, or it's just nice to know it's out there?
It's a great question. I think I'll go back to this concept of partnership, and it really is about how do you build the strongest team, and that team is obviously the folks that your teammates you employ and work with, but that team is also your board members, your investors writ large, and how do you build the best team a team that reflects your your values.
Mhm.
For us, that was important as well. So we had, and a shout out to Gaingels, a gay angel investing network that is phenomenal, invested in us several times through different rounds. And, we wanted to work with them because they reflected our values. And we want not only to have a diverse team and workforce, but a diverse set of investors. And so this concept of a cap table that reflects your values was important for us. It's the right thing to do. It's also helped us hire and recruit and really walk the walk in certain areas. And another great, investing group that has invested in us, Motley Fool Ventures, and a very values-driven organization from the Motley Fool. Obviously very well aligned in consumer finance and what we do, and it made a ton of sense. But they're also values-forward investors, and we're a values-forward company. So I think you think about the matching beyond capital, whether that be strategic advantage and partnerships. Maybe it's a corporate venture capital through it's a business development relationship. Maybe it's someone that enhances your values or a skill set.
Mm-hmm.
Venture brand does matter sometimes. And so I think you build yourself a framework and think about not just the dollars, but what are the other boxes, whether it be introductions, whether it be a set of experiences, say a partner that's taken companies public, whatever, wherever you are in your life cycle, that can be really helpful and value add. And so it's just, I think over time you broaden your aperture a bit in terms of all the different ways that investors can be helpful. And I think we're just very fortunate with the business that we can be patient and take advantage of those opportunities as they come, but not kind of try to shoehorn them or force fit them into a specific timeline for us.
Okay, good. All right, I will let you go, but any last tactics or tips or advice you'd like to share? The question I always ask is advice you would give your younger self if you were doing this all over again. Anything we haven't covered?
I think this can be hard when you're thinking about a process, and obviously sometimes it can be an existential event when you're raising capital, but the number one thing that will make your business more attractive to investors is building a better business.
Mm-hmm. Sure.
Executing is fundraising.
That's
when you improve your business and you build a better business and you execute and you hit your milestones, that makes fundraising a whole lot easier.
Sure.
And so I think the idea that building your business is fundraising, it's just indirectly fundraising, it is another way to look at it that may be slightly different, but I think is certainly true in my experience.
And I guess your evidence or supporting corroboration of that is this most recent round that was sort of inbound to you. These investors sort of approached you, if I'm understanding this, and chased you basically to get the round done, right?
Yeah, look, I don't know. I don't know that I would say chased, but they reach out, and you start to build a reputation and a brand as a company, and people start to hear about you and those types of things because you're building something that people are taking notice of. One of those groups of people take notice. Sometimes it's customers, sometimes it's investors.
Yeah.
And so, really, if you create value, you take care of your team takes care of your customers, and kind of everything else goes from there and animates from that.
Yeah.
And so if you can, work with a great group of people who we are fortunate to do, we have an incredibly talented group, and we're looking for and have a team that is good people that do great work, values-driven, mission-driven people that do really excellent work, and then you continue to build on that. Then the rest of it will generally take care of itself one way or another. Yeah,
good. Excellent. If people want to learn more, it's motorefi.com, right?
That's it. Yeah.
And is there a sweet spot in terms of either how much of a loan I need to have to really come be eligible, or sweet spot, or any other kind of target focus there?
Yeah, we serve a really broad spectrum of the population. We are nationwide. The nice thing about I would say just about the product and the team is that you can check your rate in seconds. We don't ding your credit, don't need your social. So I'd invite everyone to just check out the site, see what you qualify for. In a matter of seconds, you'll learn if you can qualify for rates that can lower that payment of yours, and it's well worth the few seconds of time to check it out. And then beyond that, you can be 1 to 2 minutes away from a firm offer of credit and a refinancing. Got it.
Interesting. Very good. All right, Kevin. Well, motorefi.com, and congrats. Sounds like an interesting business. I never thought about refinancing automotive before, but it totally makes logical sense. Kind of one of those like seemingly obvious businesses now that you think about it, right? So very good. Well, appreciate your time. We'll catch you after the next round, whatever that label may be on that.
Nathan, thanks very much. I enjoyed it.
All right, over and out. Cheers.